Hi friends, Simon here from traders.Traders. In today's video, we're going to discuss how stockbrokers make money. Let's get started.
Okay, key points. We're referring only to stockbrokers in this video. Other brokers, Forex, CFD, futures, they're going to have a lot of similarities, but just to be clear, we're talking 100% about stockbrokers in this video. The ways they make money: commissions and fees, that's the most direct way, obviously. Interest on idle cash. Cash is just sitting around in clients' brokerage accounts. Interest on cash lent and margin trading. So customers who are borrowing money from the broker to trade, the broker will be earning interest on the money that is lent. Payments for short selling, we'll get into what exactly that means, as well as payment for order flow, the most controversial way brokers earn money in terms of routing their orders to high frequency trading firms and things like that. Okay, commissions and fees. Basically, if you traded with a broker before, you've experienced this. Anytime you put on a trade, you will be charged with a fee. These fees can vary whether you place the order by phone or online, what security you're trading, things like that. There's also, depending on the broker, they can charge a whole bunch of other assorted fees: inactivity fees if you're not trading much, transfer fees if you're going to move out to another broker, withdrawal fees, transfers to the DRS system, which we'll get into a little bit, things like that. So understanding all the commissions and fees in detail is probably a worthwhile activity. This is the most direct way that brokers make money, and probably the way that, even if you've never traded before, it's easy to conceptualize it and understand. Pretty intuitive. Okay, second way that brokers make money is interest on cash. Let's say you open up an account with a broker, you deposit $5,000, $10,000, whatever, 50, 100, whatever it is. If you have money that's just waiting, where it's deposit money's in the account and you're waiting for trade opportunities or for a time to buy, waiting for the time to be right, that money is earning interest, and the broker is keeping some or all of that interest. So as a way of getting around this, you can inquire with your broker about how to earn more interest. You can put your money in a money market fund that the broker offers, and that's a way where the money is going to be very liquid. You can get it if you need it. It's very low risk, and you'll be earning some interest. In our current environment, where interest rates are very low, this might not make a huge difference, but it is still, an interest rate of 0.1%, 0.5%. It's still something. So that is some money that it's up to you whether you want to pursue this. Like I mentioned, money market funds are a way to do that. Of course, those funds aren't FDIC insured, so that's also something to bear in mind. But yeah, this is basically, what's going on. Brokers will earn interest on some or all of the cash that is not deployed in positions, and it's not in a money market fund as well. So in terms of understanding their business model, that's also a point to consider. Margin trading. Here you see the sort of rates that brokers charge based on the amount that's borrowed. Margin trading is, of course, if you are borrowing money from your broker to increase your position size. Let's say you have $10,000 in your account. You want to borrow another $10,000 so that you can put on a $20,000 position. That $10,000 you borrowed is going to be, the broker is loaning that to you, and they will be earning interest on that. So it is a source of revenue for the broker. Margin trading. Obviously, generally speaking, only a small percentage of clients are going to be engaged in that, but that's the basic concept right there. Lending your shares. This is a little more, a lot of people don't really understand this, is I guess what I'm getting at. Let's say you buy shares of a stock. Let's say you bought Apple, and those shares are sitting in their account. You bought it through a broker, and it's just sitting there, and that's fine, earning its dividend and things like that. From Apple's perspective, it's actually listing your broker as the owner of the shares, and your broker. So let's say all the broker's clients, your broker's clients collectively have purchased 1,000 shares of Apple. Apple's just going to list one owner, the name of your broker, and that's 1,000 shares. And then your broker sort of subdivides that. But because your broker is listed as the technical owner of it, when someone wants to short shares in Apple, they need to borrow those shares from someone, and they need to pay whoever the true owner of those shares a fee for borrowing it. And that broker is going to be the one who is authorized to lend out the shares, even though you bought them and you may think they're yours, and In spirit, they're yours, but in technicality, they're actually owned by the broker. So the broker is able to lend it out to short sellers, earn the fee for that, and keep that fee themselves. If you don't like this practice, if you want to own the shares entirely, you can transfer them to the direct registration system. In that case, in the example we gave, Apple will list you as one of its shareholders. Now, this is a little, you got to fill out some paperwork, and depending on your broker, they may charge you a fee for transferring to the DRS environment. But we have a whole video on that, so look it up on Informed Trades if you're interested in more on this, if you're not familiar with it. I personally have some shares in DRS where I'm the direct owner. I have other shares which I may need to, or I feel are more liquid, and I want to be able to get rid of them more quickly in my broker's name in what's called street registration. So something to consider and also you can understand why your broker wants you to hold your shares in street position and why they may charge you a fee if you're trying to get out of it, or why they generally just don't talk about this. Lastly, most controversially, payment for order flow. Okay, most typically high-frequency trading firms, which have gotten a lot of attention recently, pay brokers for orders so they can sort of run in front of them, as well as understand what the retail audience is trading. And to understand this, here's this visualization of sorts, this chart from the New York Times. Hypothetical example: an investor submits an order to a broker at 9:31 a.m. for just 5,000 shares. That order is sent to the high-frequency trading firm. They see that an order is coming up, and they can sort of jump ahead of it, right? Or they can also understand that this is what the retail audience is doing, and that's why high-frequency trading firms have been able to make a lot of money. What this can result in is traders getting a worse price on their order than if their broker did not engage in such things. But when you see brokers who are offering, commission-free trading, for X amount of time or indefinitely, or, and you're asking yourself, how are they making money if they're not charging commissions? Usually it's through these other mechanisms. And payment for order flow is a growing percentage of how a lot of brokers are making money. That's about it. Any questions you have, anything you want to add, join us at informedtrades.com. If you want to help us grow, check out informedtrades.com/donate. Also, liking our video on YouTube, sharing it on Facebook, Google+, that also helps us out as well. Best of luck in your trading and investing, and we'll see you next time. Take care.